Hello everyone, I am Anita, Assistant Professor, Department of Commerce. Today we are going to see about the case study video from the subject is Financial Management. Let's see the topic is.
Introduction to capital budgeting. Capital budgeting is a financial planning process used by companies to decide whether they stock, invest in long-term assets or projects. These investments usually require a large amount of money and their benefits to receive over many years. Because these decisions affect the future growth and profitability of the company, they must be analyzed carefully. Example of capital budgeting decision includes purchasing new machinery or equipments, expanding production capacity, opening a new factory or branch, investing in research and development, launching a new product line. The main objective of capital budgeting is to determine whether the expected future returns from an investment are worth the cost of the investment budget.
Importance of capital budgeting. Capital budgeting is extremely important for businesses because it involves long-term financial decisions. These decisions cannot be easily received once the money is invested. Most reason why capital budgeting is important. Large investment amount. In the large investment amount, capital investment usually requires a huge amount of money. A wrong decision may lead to significant financial loss. Long-term impact. The investment affect the company for many years. For example, a machine purchased today may be used for 5 to 10 years. Next comes future profitability. Capital budgeting helps whether a project will generate sufficient profits in the future. Use of resources. Companies have limited financial resources. Capital budgeting helps allocate funds to most profitable projects. Efficient use of resources. Companies have limited financial resources. Capital budgeting helps allocate funds to most profitable projects. Next comes the risk reduction. By analyzing investment proposals carefully, companies can reduce financial risk, avoid unprofitable projects.
Case study explanation. Let us understand capital budgeting with a practical example. A manufacturing company wants to increase its production capacity. To achieve this, the company plans to purchase a new machine. Details of the investment. Cost of the machine 5 lakh, expected life of the machine 5 years, scrap value at the end of life 50,000, estimated annual profit generated 1,20,000. Before making this investment, the company must analyze whether the machine will generate enough profit to justify the cost. For this purpose, management uses capital budgeting technique. Capital budgeting evaluation methods. There are several techniques used to evaluate investment proposals. The most commonly used methods include payback period method, net present value method, internal rate of return method.
Next one, payback period method. The payback period refers to the time required to recover the initial investment from the cash inflow generated by the project. Payback period method formula. Payback period equal to initial investment plus annual cash inflow. Interpretation. The company will require its investment in approximately 4 years and 2 months. Since the machine's life is 5 years, the investment can be recovered before the machine stops operating. Therefore, a project may be considered acceptable. Advantages of payback period. Simple and easy understand. Help measure investment risk. Suitable for companies needing quick recovery of funds. Disadvantages. Ignore profit after payback period. Does not consider time value of money. Not suitable for long-term project alone.
Hello everyone. The conclusion part. Capital budgeting is a capital financial management that helps a company evaluate and select long-term investment project. Since this decision involves significant financial resources and have long-term implication, proper analysis is necessary. In this case study, the manufacturing company analyzes the purchase of new machine costing 5 lakh. By applying capital budgeting techniques such as project payback period, net present value and the initial rate of return, management can determine whether the investment will be profitable. If the expected cash inflow are sufficient to recover the investment and generate additional profit, the company can proceed with the project. Otherwise, it may reject the proposal. Therefore, the capital budgeting ensures efficient allocation of financial resources, reduce risk, and promote long-term business. Thank you.